Welcome to another episode of Follow the Money. My name is Joshua Belanger, and I have some very interesting option activity, some that we've been seeing over the last few months, and it's been written about. They've been referred to as whale trades, the Nasdaq whale trade. And SoftBank, who's behind these trades, supposedly has made about $4 billion off these big whale trades. And interesting enough, it looks to be where they're positioning themselves for more upside in this specific name. So let's take a look here at STM. This is a stock here. We've talked about this a few weeks ago. I think it was early August, maybe late July. And we've been seeing this activity with these big buyers coming in these out of the money calls, spending big money, these big whale trades. Finally, it's popped up to $33. They've been positioning themselves for $35, but finally, after this coming back and forth, it's popped up to $33. And right now, they're looking for shares to hit $40 by November. So let's take a look here at the activity. Right now, on these October contracts here, we notice that the open interest on these are 26,000 and 16,000 today traded. These actually were closed and looks to be rolled into these November contracts here. Now, I don't think they close these positions out for a profit, but they're closing out to buy more time here. So sometimes you can close out for a profit, and sometimes to manage the position, instead of just letting it go to zero, if you buy an option, instead of letting it, let's say you buy it at 50 cents, instead of letting it go to zero, if it doesn't happen to be in the time frame, you would, let's say, roll it at 20 cents. You take a loss, but at least you salvage that and you roll it to at least buy yourself some more time, because if you think you're going to make 4, 5, 6 times your return, well, the 30 cents is not really going to mean too much. So here, the November contracts, this is where they're targeting that 40 strike, and 10,000 contracts traded here. So let's look at the time and sales, and we can identify specifically that those contracts were closed in the October here, and we look at the time and sales, and at the same time, it looks to be where they're rolling that 40, or rolling into that November 40 strike. Now, $33 to 40 is $7 in 50 days. That has to happen. That's a pretty big move. Now, one thing that could be a strong catalyst is that shares are hard to borrow. And with prices at 52-week highs, we could see those shares that are short forced to buy in or forced to cover, and that could create what's known as a squeeze, and that's going to create more momentum, forced buying, with momentum buyers chasing that activity, and that's where we see that big move, possibly $3, $4, $5 in the next 50 days. Not saying that's going to happen. That could be what we see, or what they're looking for. Now, again, 40 is way out of the money. The probability of this happening, prices expiring at $40 at expiration in the next 50 days, is 80% unlikely. So one way to trade this activity, position yourself for that momentum instead of looking to hit a home run, would be to do a call spread. So what we would be doing is selling, or buying the 35 call here and selling the 40. And that would look something like this. Price is closed at 115. 115 minus $5, which is the width of the spread. That's the profit potential. That could be where you take that $1.15 and make 2, 3 times your return on a position like this. That's the beauty of options. That's why I love them. Look out for this trade, and I'll keep you updated on some more coming up in the future.